which is the core tool used by macroeconomists around the world today. These models have indeed become the foundation of modern macroeconomic theory. The economics profession owes a great debt of gratitude to Professor Prescott for his uncompromising commitment to scholarly excellence, for his dedication to his students, and for the advancement of economics as a quantitative science. We are honored to have him here today with us and proud to continue the high tradition established by the George S. Eccles Distinguished Lecture Series. Professor Prescott.
Thank you, Dean. It's great to be here. I see the dynamic people. I like to see the young people because they're the ones the future depends upon. But this is about retirement. I'm going to give you what the president of the Czech Republic told me. It's very predictable. Every year you'll get a year older. And someday, you're rich, by the way. Take the present value of your current and future time endowment, and you're worth maybe $6 or $7 million. That assumes you work 80 hours a week and retire when you're 67. And none of it gets taxed away. In fact, but then you people are not average. You're far above average. This work is with Ellen McGrattan. We started out looking at the value of the stock market and found out that stocks are worth a lot more than, for some companies, than the physical capital goods they have, the book value, the depreciated value. Coca-Cola, General Mills, Microsoft, they had something else that did not show up in the book, something that is not measured, intangible capital. Brand names are worth a lot. Walmart is worth a lot more than its stores. So we figured out a way to bring that in. Everybody knew it was a big number. The investments made in this, the advertising, the R&D, building organizations, training young new people to come to work for the organization, and building that organization. When you get into an organization, it takes a while to learn about who knows what and who to trust and other things, and that's capital. Knowing how to solve things yourself is best, but knowing somebody who can tell you the answer is almost as good. And you do this by interacting with this. There's these big positive externalities. That's the concept of organizational capital. Okay, I say economics is applied science. There's some theorists that develop language, which is so important. And with better tools, we can do better analysis. These are great times for economics. We have so many great problems that we can now solve that we couldn't in the past, given the tools that had been developed. I think Kydland and my key contribution was the development of tools that have been used by so many people to derive scientific inference. But the question that we have here is financing retirement. I look at the demographics. In most countries in the world, not many babies are being produced, and people are living longer. In the retirement years, there had fewer disabilities. Morbidity rates have gone down. So with this demographic change, that may lead to about 3 workers per retiree, may go down to 2 workers per retiree. Retired people and workers seem to consume about the same on average. So that's a lot. By the way, one way to do this, Paul Samuelson, you can have a lot of government debt. I was teaching an undergraduate course. My teaching associate was Catherine Birkeland, and we tried to do gave them, the students some exercise. We worked out some exercises. We want some lectures about financing retirement and make the models a little bit dynamic. And then we did this and found out with the new demographics that are coming, you could efficiently finance retirement if you had a huge amount of government debt. A huge amount, I'm talking 5 GMPs or GDPs, annual GDPs. We know that governments can't honor that. Any Greeks here? Argentines? So with surprising regularity, governments default. The collective entity we set up, the government, defaults on its promises. So I say the big government debt is infeasible. I got a lot of trouble with the Fed system with this one little comment I made in a Wall Street Journal editorial on the needed quantity of government debt. What's the unpleasant conclusion? Must rely on distortionary taxes and transfer schemes. And more so as the population ages. At least this is what we thought before now. People use the wrong capital stock. They don't include this intangible capital. With reasonable estimates of the stock of capital, by the way, savings, where can households save? Everybody can't lend can't increase it by lending to other people because the other people have to reduce they have to borrow. Borrowing equals lending between households. So the only place to save are in real assets, houses, factory, businesses, tangible, and government debt, if you take the overlapping generation approach. Bob Barrow doesn't. He takes the dynastic family. And then government debt's not part of household wealth. There's future tax liabilities. What is a reasonable estimate of stock of capital? With a reasonable one, the arithmetic becomes pleasant. Governments rely much less on costly tax and transfer. What's wrong with taxing young and making lump sum transfers to old? It distorts the young's decisions on how much to work, and there's huge deadweight loss associated with it. If the government could honor the debt, well, young save by buying government debt from the current old. Current old just save to finance their consumption by lending it to the young. That's the heart of that classic paper by Paul Samuelson. And this is true for both current and projected demographics. What do we do? Overlapping generations. Finn and I in our business cycles used a dynastic model. It turns out for business cycles and small, unimportant things like them, it doesn't matter which one you use. But when you get to something like retirement, financing, it does matter. And the empirical evidence has come in that it's the overlapping generation. With the dynastic, if the utility of your children enter your utility function in just the right way, then it's as if you're an infinitely lived family. But when they do, now that we have the data sets and the people like Donardi and some other of Sargent's students and also Imrul Horlu's have been finding that empirically it's overlapping generations is the factor. People may leave bequests, but they're mostly accidental. They save for the retirement and under the hopes that they'll have a long life. They don't want to run out of savings. They have a buffer stock, and So population grows at a constant rate. This is going to be steady state analysis today. Later on, I'll talk about that at the very end, about the transition from in the dynamic equilibrium path, not just the balanced growth. People live J periods and retire at J sub R. This looks ugly, but I was told by Frank that this was a scientific one. And if I didn't have things like this here, basically people's utility depends upon their consumption, C, and their 1 minus L. L is a fraction of the time you work. So 1 minus L is a fraction of your productive time that you don't work. Economists, macroeconomists call that leisure, though a lot of that time is household production time. The budget constraint is there's a tax and consumption, plus next period's assets is 1 plus the interest rate on your beginning of period assets. Tax rate on labor, income, W is a wage. That little ugly epsilon J is the efficiency units. As you get older, you're not as efficient in production. You can't work as hard as you can. So your E's bigger. Some people get more human capital. Maybe as you get older, you get more of that. That increases how productive you are, and that increases your E, or your salary and wage income. And then there's these transfers from the government, lump sum. Production function, Cobb-Douglas, except 3 inputs, just tangible capital as well as intangible capital. The tradition has been to ignore intangible capital. Everybody knew it was big number. People did not have a way to bring it in. For those of you who have had a advanced undergraduate macro course, you can see these Z that grows at rate gamma. This is labor augmenting technology change. The total, and it's easy to write that way because the growth in Z is the same as the steady state growth of the economy. It's consumptions, per capita numbers. Now the total amount of, one thing is there's a big distinction between ownership of capital between households and government. This is another thing that's been ignored previously. The fact that you own your house doesn't mean you own all that. You have to pay something called property taxes. Effectively, the government gets about a 35% of the services of that house, and they're about 35% owner, with most tax rates in the United States on property. Over in Europe, they're lower on property. The intangible capital is another one. With intangible capital, what happens if you're making a lot of intangible capital investment, a lot of R&D, training a lot of people, figuring out launching new products, building up clienteles? Your current accounting profits are lower. But you're making this investment, but you can expense this. And how high do you think the corporate income tax rate is in this country? We're about the highest in the world, by the way. The rest of the world's coming down. If you include the state with the federal, it's at 40% almost. So this means that the government is paying for 40% of the intangible capital, and they're owning 40%. That's a subtle issue, and if you have to dig through these ugly budget constraints to figure these things out. Dividends are D. H is household or private. G is government or public. I wish private and public started with different letters, and so I could use those 2 different letters. So I did this. When I say household, I mean the consolidated private sector. I consolidate the household with the businesses they own. So in other words, if you own some shares of stock in your retirement fund, you own that share of their capital stock, and you have that share of their liabilities, their debt. Same thing for unincorporated business, et cetera. So we sort of, it's really the private sector, not the household sector. It consolidates those three. It reflects all the capital owned directly or indirectly, or by the businesses which people own. This is a little different language than you normally hear, but I think this is one area where we have to go through the pain and suffering of programming ourselves to use the alternative language, or maybe a better one that some of you people will suggest. The government budget constraint is they use some for public goods, some for transfers, some for paying interest on debt, IB, interest, debt, bonds. They get revenue from the consumption tax, revenue from the tax on labor, revenue from the House of D is distributions. When businesses distribute things to their owners, taxes are paid. This is a big difference between whether or not you finance by new equity or by retained earnings. Turns out that virtually all investment in the major corporate sector, the Schedule C corporations that pay income tax, not the Schedule S, which are like proprietors, is you have to have this correction. P is profits, and capital Pi is profits. So there's dividends which the government receives on their effective ownership. Not their legal ownership, but their effective ownership, which is you sort of have to revise the way you do the flow of funds accounts. And when you do that and work on that, it gives you a headache. But there's some pain and suffering in working these things out. And the deficit is the B prime. B prime means priming that next period. Prime next period. Then you don't need all these T and T plus 1 subscripts, which make things even uglier. Government, there's a set of tax rates. Okay, I guess we've defined all the variables. Now here's the value. The value of private tangible capital. That's a tax rate on distribution. If you own a tree that bears fruit in the backyard, like a Lucas tree economy, or pure endowment economy, what is the value of that tree if you own it? And the government takes 40% of it, of the fruit that is produced. It's only worth 60% as much as the tree. You own 60, the government owns 40%. By the way, the tax on distribution in the 60s was averaged 4% in the United States. Now it's a lot lower. There's been some major improvements in our tax system. Things don't always get worse. Some things get better. These are these deferred compensation and paying tax schemes, the 401ks. The academics were the pioneers in this with their TIA craft, and subsequently the great expansion of alternative plans. The IRAs are another example. Now the intangible capital, how does that value show up on the balance sheet? This is the intangible capital the household directly or indirectly, or mostly indirectly, through, say, their shares of Coca-Cola or General Motors or Microsoft. Well, there's that distribution component, but there's also that 1 minus tau in profits. And that profit tax is pretty big. Total private asset holdings of households or people. Government debt plus the value, which is not the same as the cost of reproducing stuff because of the various tricky little things that the complexities introduced. It'd be nicer to have a simpler, cleaner system so things are transparent to people to know what's going on. Now you look at Bureau of Economic Analysis, they create the national income and product accounts and the fixed asset accounts, Department of Commerce. Flow of funds is by the Federal Reserve Board. That gives the balance sheets of the various sectors. We had to use that a little bit to figure out the value of land. There's fixed assets, consumer durables, inventories, and land. But the intangible capital, there's two types that McGrattan and I estimate. One is plan specific. When you train your workforce and arrange for local suppliers, etc. If you're a store like Walmart in Logan, if they have one, building clientele and advertising and getting things that are specialized to this area. The other is technology capital. This can be used at multiple locations. Here there's a big split in the profession. Not big split. Everybody else is going to the monopolistic competition route. And all kinds of products. This whole new revitalization of trade theory has used that construct. Paul Romer, in his monopolistic competition growth model, uses this. But we don't. We stay within the tradition of constant returns to scale, where you have a Solo's theory of the income side of the national income account. Factors paid their marginal product, exhaust product. And there's no aggregation theory behind that. Footnote 7 in his classic paper. The total stock is 5.8 GDPs. Now, that's a pretty big number. I suspect it's about $350,000 for every man, woman, and child. It would be bigger than that, but I did my arithmetic fast then. Not the 3 GDPs that everybody's been using. By the way, this does not include one of the most important forms of human capital. On the job, human capital acquired is about 2 GDPs. That's Lockhart and Heckman's and somebody else's estimate, as well as Parente and mine. We independently came up with the same number. When you start out working, the younger people here, initially your wage or how much you get paid will go up. Why? Part of your compensation when you're young is the skills you learn on the job. Now, there's a lot of skills you learn prior to getting on a job. Here at Utah State in the business school and in other departments. And that's probably another 2 GDPs. Now, however, you cannot use human capital when you retire, because you're not allowed to sell yourself. You can rent, you're no longer renting your services. So that's for this question. It's safe to abstract from that feature. For other issues, you better have that in there. But what's a good abstraction to use to address a question is question related. And all models are abstractions. So if you use a reality argument, no models are realistic. Yet that doesn't mean they're not useful for drawing inference as to the answer to some important policy question. I'm going to do two worlds, one with the current demographics and one with the we're about 1% population growth, and people have a certain, well, currently we've shifted to put the survival rates in for retirees. The second one is where zero population growth. And this is where mortality rates fall, and as a result, survival rates go up. And people have longer retirements, and a higher fraction of the population in the steady state are retired. We have both the tangible and intangible assets. And we make comparisons with the government policies. Now, this difference, 3/4 workers, 1/4 retirees versus 2/3 workers, 1/3 retirees. So we did two calibrations. We matched up the parameters of the model in that production function so that total stock of capital equals to 5.8 GDPs. By the way, this paper that we pulled this 1.7 intangible capital came out last month in AER. Now the total, of course, papers come out well after they're written. They're just for historical records. The total stocks equals 2.8 GDPs, only fixed assets. Solow had an even smaller one in his classic paper when he did these type of exercises so many years ago. And it implies with the more capital, there's a bigger capital share. 46% as opposed to about 30%. Labor share is 54 and 20 and 70. Because the income is split between capital and labor, wages and salaries. These are set to match the statistics in the model to match the current balance growth statistics. Now, this is one area where I was hoping to have this to report to you. In the model, average tax rates equal marginal tax rates. In fact, they don't. Think about your income tax. Take what your marginal tax rate is and multiply that times your income. And then compare that with the total amount you have to pay. It's considerably less. How do we get this? Well, we say that difference is a transfer. And we use the marginal tax rate. That's if you calibrate to the average tax rates, which are the appropriate ones. Marginal are higher. That's why we must add this subsidy. We have switched to the marginal, but the results are just popping out of the computer. And there's some choices of how many different things to stick into the model that we haven't fully. The model gets too complicated, that's bad. You want to keep things simple as possible and still provide an answer to the question you're after. I preach a methodology. I apologize. Well, these are the results that I'll show you today. These tax rates are too low, particularly the tax rate on labor, Tau Sabel. What are more reasonable ones? About 34% on that. Remember, there's Social Security taxes in there, and Medicare taxes. And these profits, it gets complicated because there's these Schedule S and unincorporated businesses, but most of the owners of those, the profits get distributed to the household and they pay tax like ordinary income. And these people are in the higher tax brackets. When you count state and local as well as federal, you get up there around 40%. So it may be going a lot higher if we, but who knows what tax rules will be instituted in the near future. In the distribution tax, about 20%. It used to be a lot higher. Remember, high theta means we're including intangible capital. Let me be careful here. The key numbers to see is this high first column, high theta, with the intangible capital. This is the current world dynamics. Tangible investment is 26% of GDP, which does not include intangible investment. So investment is, with this intangible capital, is a significantly bigger share of output than if you think in terms of than if you abstract from intangible capital. 26 plus 11 versus the 22 in the second column. These are the investments. There's also a big difference in the new world. That 22 and 0.09 are investments under the new demographic steady state. You want it's only 19 under the if the capital share is small. Why? With lower population growth, you don't have to produce as much capital for the new people to keep the capital output ratio fixed. But still 31 versus 19. So the relative importance of consumption has come down somewhat, investment up. And if we add that human capital, it'd be even more dramatic. As I emphasized, state is capital share. On this labor income, we normally say about 70% goes to labor, 30% goes to capital. Now this capital, that 30%, 12 or 13% is depreciation. Some of it is implicit rent on owner-occupied houses. Some of it is corporate income taxes, a few percent. And some is private business after-tax profits, maybe 6%. That equation at the bottom is an important one. GDP is output minus intangible investment, or output is equal to GDP plus the unmeasured intangible capital. GDP is measured output. And for cyclical purposes, this unmeasured stuff is big time. Back in the late 90s, we were sitting around there at the Federal Reserve Bank of Minneapolis and wondering, why are people working so much? Did they get a case of workaholism? GDP was not that high. Normally in a boom, 2/3 labor, 1/3 productivity. In that boom, it's 125% labor and minus 25 productivity, output per hour. That looked weird, and that I was surprised that I was being attacked by for that major discrepancy with theory, because the theory worked so well up to 1990. But McGrattan and I resolved this by, we know there was a big boom then. You know, people out were in LA where the cab driver was getting his $20 tips. So, some of the little kids who were now about 23-year-old, who I used to coach in Park League soccer, were multimillionaires with starting their businesses. By the way, they lost most of that money, though they did walk away with houses, those two. Thumbsuckers when I first saw them. But they developed into mature, successful, and people were dropping out of business schools to start up their businesses. Entrepreneurs became the big, major. Things were happening. Corporate profits were way down. Why? Corporate accounting profits. Why were they way down? Businesses were investing like mad in R&D. We have some direct measures of that. We also have, people sort of shifted occupations to the occupations where people work longer hours and are in like accounting, business, engineers. They're closer to the ones that are starting up new businesses. And when you do incorporate, we assume that technology change was non-neutral with regard to producing measured output and producing unmeasured output, rather than the standard assumption that it's neutral. And we're able to figure out what those productivity parameters are by looking at current data and running things and plugging them in. And then the data, the predictions of theory and measurement, the predictions of theory and observations came together. That paper is finally coming out after many years this month at the Journal of, that new American Economic Journal, the new macroeconomics, the new AER one. So it made me feel better to have that puzzle go away. I discussed that in 2004 in my Nobel Prize address, saying I want to get back to work and resolve that puzzle. And with the help of Ellen, we did it, and we were happy. To see theory work. Now oh, by the way, what's the flip side of that? Indeed, output, not GDP, measured plus unmeasured, did boom, and everything behaved in accordance with theory. Right now, don't believe those GDP numbers as good measures of output. Focus on the hours worked. If you have questions at the end, I can expound more on that. The statistics that came in today said no recovery. The civilian employment rate, flat, no increase, unfortunately. Hopefully things will be a lot better by next year when many of you enter the job market. It was so easy for my students to find jobs. They just had a big list, and then it got hard the last couple of years for them. And they're happy if they have one good offer, not sort of say, I got 5, and which one should I take? This has hit this current, and this depressed state of the economy has been persisting for a year now, 10% about. Okay, government spending, what do we do there? This is pure public goods or bads, depending upon your perspective. It's military. A lot of the things like the roads you use, the courts, the inspection systems, police protection. These are sort of local, these are what we provide and is really part of our consumption. It's not public consumption, it's a sort of a local public good is really part of the people in that locality's consumption. So, well, notation, I guess I've told you about this, tangible, intangible, market value versus reproduction cost, household combined with businesses H and government G. Well, this gives these stocks. Let's see if there's any point I wanted to make here. Look at the third column. The government part has gone way down in the new world, and the household part has gone way up, the 3.4 versus 0.6. So there's more savings opportunities for the households. There's a shortage of savings opportunities that get decent returns under our current arrangements. We can change them. We can, by shifting the ownership, effective economic ownership to the private sector. By the way, through all these experiments, we assume policy is such that the interest rate, return on capital is 4%. It's been about slightly above that for the national income accounts since they started in 1929. There's little fluctuations. You take total profits after taxes and divide by the total amount of capital, and you get about 4.2 or 4 point. We rounded to 4%. In the current world, the government effectively owns half of the capital. In the new world, it's only about 1/7. By the way, we don't let the government take short positions in the stock market. That's effectively government debt. And we put a rule that there's a limit on the amount of government debt that can be issued. And honestly, in a credible way that pays it back. And by the way, we also ruled out lump sum taxes. Life would be easy for the public finance if you did that. But everybody, when Maggie Thatcher tried to impose a poll tax, what happened to her? She was kicked out of office. Now, okay, tax puts a wedge between value and capital. We've seen that before. Implying effective government ownership through taxation. Remember, that's a key point. You're not going to assimilate all this. If you did, please come down and be my co-author. I'd like to free ride in this short time. Well, policy experiment. Eliminate tax on capital income. That's one thing economists agree on. Taxes on capital income makes future consumption more expensive in terms of current consumption than what the transformation is. And it's effectively taxing intermediate goods, which bring you inside the production possibility frontier. Diamond and Murley's in a dynamic setting. Eliminate transfers to retirees. You can still have mandatory savings like Australia does, so that your parents can spend all their money and then come to their kids and say, give me, or go to the state and become wards. They will have the money. And furthermore, Australia requires people to annuitize when they retire. It's real, and so they can't outlive their savings. We held fixed debt to GDP, spending on pure public good consumption, tax rate on consumption, labor, and dividends. I think the third column is the most interesting. The welfare gains of having this is shifting taxes is bigger in this with this more capital. By doing some of this, reducing the transfers to all and mandatory savings or purchase, like Singapore, they even have mandatory purchase of savings for healthcare. The gains would be even greater. By the way, insurance is different than savings. There's good reasons when there's third parties effective to have mandatory insurance. Well, I guess there we came up with a negative government capital, which was buying short, which we don't like. That's with the low capital share. And we would be back to the unpleasant arithmetic. This is just big arithmetic once you lay down the model. It's a lot of arithmetic, but arithmetic. The future, transitional dynamics, parallel code, cohorts distributed across processors. By the way, we're fortunate to have, Ellen and I, to have access to, well, there's 2,200 computers in parallel. It's the computation intensity of the aeronautical engineers. Her husband is an aeronautical engineer, and figuring out landing the modula on Mars. In a lot of, that's computationally intensive. And it's pretty straightforward, but it's just a lot of work for the computers. But if you have a lot of computers doing the work, no problem. Well, that sort of summarizes the findings. If unrestricted government capital, negative in some years, but constrained analysis violated in low theta case. This is where we computed the equilibrium transition path. It's not, and you'd want to know the welfare gains by each age cohort or loss, but they think there'll be gains. But there's so much more to do. With these better tax rates and the better representation of the ownership going through the Schedule S corporations, which are like partnerships with limited liability. Everything is distributed to the worker owners. If you own a Schedule S corporation and don't work there, you get none of the profits. They pay no profit tax. And there's some of these gains on the, well, we're getting a lot of the intertemporal over time, making that trade-off better between consumption now and the future, more in line with the ability of the economy to transform. The intratemporal is another important margin. within periods between consumption and well, I see this as an ambitious research program, and we're going to know a lot more in a couple years. And I suspect other people will, in criticism received, will be very helpful. I'd like to thank you for the attention. I guess that's the end. Thank you.
Professor Prescott has agreed to take questions. We'll take just about a 3 or 4 minute break right now to allow those of you who have to go to other classes to do so. Those who want to stay and ask questions, we'll do that as well. Just take about 3 minutes.
But they make me wanna melt their face away. I once made them spray, now I can make them put the case of what been thugging all my life. Can't say I don't deserve to take a break. You'd rather see me catch a case and watch my future fade away.